Well, stocks finished the day at new records after the Senate took a big step, toward tax reform. More on that in a moment. But we begin tonight with a company that is an American icon, albeit today a tarnished one, General Electric. Today, the company missed earnings forecasts by a lot. A stark reminder of the work that lays ahead for the new CEO. He summed up the quarter by saying, "Our results are unacceptable, to say the least." Early today, Wall Street agreed. But after falling sharply, the stock made an about-face, an abrupt one, embarking on its biggest comeback since 2009 and finishing up 1%. Morgan Brennan takes a look at the quarter and what may be ahead for GE.
For General Electric, it's all about restructuring. Still, the oldest stock in the Dow's new CEO, John Flannery, says everything is up for review as he begins to make, quote, sweeping changes at the struggling company.
I've spent really 90 days exhaustive review of the whole company. So that the businesses, our culture, corporate spending, everything at the company has been up for examination. Every stone turned, no sacred cows. The
comments came on the heels of a particularly disappointing quarter. Earnings missed expectations by 20 cents, and full-year profits were dramatically slashed. But the biggest surprise was operating cash flow. GE had previously forecast $12 to $14 billion for 2017. Today, it cut that metric in half. Flannery is already taking steps to rein in costs, eliminating what could be thousands of corporate jobs, grounding the fleet of company-owned jets and shuttering some research centers. Today, he doubled GE's cost-cutting forecast to $2 billion for 2018. But with all this talk of cost-cutting, investors are concerned about the future of the dividend. Flannery did not make any promises it was safe.
I look at all the capital allocation things quite rationally. If it makes sense to pay a dividend, pay a dividend. If it makes sense to buy stock back, buy a stock back. If it makes sense to acquire a company or sell a company. So I don't view it very emotionally, really. It's all around what's the best use of the company's resources, management capital, financial capital, and how does that accrue to the benefit of the owners.
Flannery says a final decision will come soon as he gets ready to update investors in more detail next month. But analysts and shareholders increasingly believe a cut is in the cards, especially after today's report.
Clearly, a dividend cut would free up a lot of flexibility for John Flannery to execute his restructuring. $8 billion a year in dividends is a big burden. He has the most political capital he will probably ever have between now and November 13th at the update meeting. So he has to think very hard about this. He has one opportunity to cut the dividend, and this is it.
Some are more upbeat about the prospects than others, especially since Flannery also said he will shed another $20 billion of assets over the next several years.
If he can do anything at all to create value, it's a $30 stock. I mean, it's really as simple as that. And similar to Honeywell was the same way. I mean, it beeline straight from 20 to 30 once Dave Cote got the train back on the tracks.
What GE will spin off remains a mystery, at least until next month. But analysts are already pointing to healthcare, transportation, and GE's oldest business, lighting, as possible candidates. For Nightly Business Report, I'm Morgan Brennan.